Good morning, this is Kim, and I want to give you an overview of a mutual fund evaluation for you to complete for homework. So I want to start this evaluation first by going to Vanguard.com. So if you just went to the home page of Vanguard, you would notice down here at the bottom that there's a link for uh, browsing Vanguard's mutual fund lineup. So if you could go in and click that link. It's going to be important that you know how to do this because your homework will involve using this link. Okay, so here I am. Top of the page it says Vanguard Mutual Funds. And what I want you to notice here is, first of all, these are ordered by asset class. Asset class. So we're going to start with the mutual funds that are at the lowest end of the risk category. And then as we scroll down this list, we will see that these different funds become more risky. So first of all, you'll notice that money market funds are at the top. Again, money market funds we've already discussed. Do they include savings, CDs, money market accounts, etc.? So even mutual funds have money market accounts right here at the top. And again, like they were at the lowest end of our pyramid, they really represent in the mutual fund space a place to just hold funds until they're invested. The reason they're a holding place is because, as you can see, they don't make us any money over here. It's just a safe place for money. Okay, moving on. We're going into the tax exempt. These would be munis. Again, they're munis from different states, which is fine. We have a California tax exempt money market. Again, nothing to be made here. Moving up the pyramid, we would move to bonds, and this is exactly what happens here. Bond funds that are treasury or agency implies that they are federal government bonds. And if we look at their year-to-date returns, we can see that they are making more than money market accounts, but barely keeping up with inflation. I'm going to move on just to show you that when we move to a different category called investment grade means we're referring to corporate bonds with a rating. So these are going to have, in this mutual fund, for example, I'm going to click on this intermediate term investment grade right here. And we'll notice that its risk potential is 2, so it's not as risky as some other investments we're going to review today. And we notice that it's intermediate term bond, and again the intermediate has to do with the maturity date. So a short-term bond would be bonds that mature maybe in a year or a year or two. Intermediate might be 2 to 5 years, maybe even 7 years before that maturity date occurs. The next thing, while I'm in Vanguard, I'm going to go ahead and click on this tab here called Portfolio and Management, and I'm going to notice that there are over 2,000 bonds, individual bonds in this fund. So when we buy into funds, as you learned from the videos last week, we're buying diversity. We're buying a lot of an investment, not just one individual bond or one individual stock, but instead a number of different investments in one fund. Now, in this particular fund, if I continued to scroll down, I would note that these corporate bonds are distributed by different areas, mostly in the finance area, and that they are typically higher rated bonds. So these are the versions of the A's with some B's, and no junk bonds or no poorly rated bonds or unrated bonds for that matter down here at the bottom. So a particularly safe bond fund with A-rated bonds, which you know are likely to repay the coupon payment as well as give your money back at maturity. So that would be a bond fund. Now I'm going to pop back out here to my list, and I'm going to continue to scroll. Below investment grade would be high risk or junk bonds, high yield corporate bonds. So they're below investment grade, they're going to be in the C category. Tax exempt, more munis right here, general munis, and still state specific munis. Okay, now I've hit this new category called balanced funds, and these are great funds. The way a balanced fund works is you can see right here, these are all target retirement funds. And the date at the end represents for you specifically the date you would retire. So for many of my students, their retirement dates are way out here in the future, target retirement of 2055 or even 2060 or anywhere in between. If I looked at a target 2060 retirement fund, before I do this, I want you to think about that for a minute. What would be in a target 2055 retirement fund, given that an individual who would select this fund is typically very young, not going to retire in until year 2055? So I hope that you would think about that and say, well, probably if I had a lot of time before I retire, I would spread my asset allocation into potentially higher risk or more stocks. And if you notice this fund, it has a risk level of 4, which again was significantly higher than our bond fund of 2. And as you can imagine, here is the asset allocation. Almost 90% of this fund is invested in stocks, with only 10% invested in bonds and almost no cash. Again, it's because of that time factor. Lots of time till retirement here. And remember, overall, in the long term, stocks outperform bonds almost 2 to 1. Now, in this fund, this is a fund of funds, because what Vanguard has done is they've said, okay, I'm going to take all the money in this fund, and 54% of it is going to be invested in the total stock market. Another 36% is invested in the international stock market. And note the word here, index, 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 and index. So these are all index funds, which I'll explain in a bit. Okay, I want to contrast this. So this is 2055, long time to retirement. But what if I was already retired? Maybe I had a fund that was year 2015. So if I clicked on a 2015 fund, which means I retired this year, the risk level has dropped. And the reason this level has dropped is because my asset allocation has shifted from stocks to a higher allocation of bonds, given that bonds are generally safer than stocks. And that it's really important to understand this, because as you age and near retirement, it makes more sense to shift your assets into something safer, because the idea of saving all these in retirement is that you're going to need to spend this money in retirement. And if you had all your money in the stock market and we had a big dip in the stock market, like the recession or the tech bubble or any other dip we've had before, you could potentially lose the money that you need right now. And that's the last thing you want to do. When we're in retirement, we don't want to expose our money to extremes amount of risk, because then we may not have it to live on. So we're not greedy individuals. Instead, we are thoughtful investors, and investors who understand this know that it's an important time to start shifting your money from stocks to bonds as you age. And that is what this fund will do for you. These funds are also great because they make the transition from stocks to bonds automatically. In other words, you don't need to go in every year and adjust your allocation. Your allocation will be adjusted for you. So in reality, you could put all your retirement in one fund, just some type of target retirement fund, and continue to invest in that fund as you age, and the asset allocation will switch for you. Okay, coming back out here. Again, we're moving down the risk. Well, we're moving up in risk, but I'm going down this list. This target risk, or another type of balanced fund, they would include both stocks and bonds. This would be a very conservative fund, so not going to expose you to a lot of risk. And then you have a growth fund. This fund is going to be more heavily invested in stocks that have growth potential. An income fund, Again, we're looking for typically those high dividend payers that are a portion of income stocks, and then something in between, which is moderate. All right, these are some other balanced fund that Vanguard offers, and interestingly enough, this star fund was the very first fund that I had my students invest in 15 years ago, simply because it was inexpensive at the time to get into this fund. It was $1,000 instead of the normal $3,000 to walk through the door to get into a mutual fund. This one was only $1,000. Uh, Now moving on to stock funds. These are 100% stock funds. They are higher risk, but again, the returns are higher. And then mid caps, not it within the stock category. These are medium-sized companies. Most of them we may not know when we click into one of these funds. And next we have small cap. These are very small companies, but again, higher risk because these companies may not have been around a long time, or they're not very big. They don't have a very large market share. They may not be the industry leader, but there is potential to grow in these types of funds, but they are significantly more risky. And then as we near the end here, we see international. International would be more risky for us because they include companies that we've never heard of, or we don't know a lot about other countries because we don't live there. So they are certainly higher risk for us. And then lastly, I'm going to go to the sector and specialty funds. Again, these are for individuals who really have expertise in the area of energy, for example, which most of you don't. And you can see energy has been hit really hard because of the oil price issues in this country and abroad. We also have healthcare, and then precious metals and minings, and then lastly we have REITs, real estates. This is a way to get into the real estate market without purchasing property to rent or as an investment. Again, very high risk because we're not experts in this area. Wow, that's a lot to digest. Now I'm going to look at one fund in particular, and it is going to be a stock fund for illustration purposes, and it is called the Vanguard Dividend Growth Fund, VDIGX right here. But I am actually going to leave Vanguard to do this evaluation, and I'm going to go over here into Morningstar. The reason I'm going into Morningstar is because the company Morningstar as a whole has a significant purpose, and that's to evaluate funds. Like with bonds, when we looked at bonds and bond ratings, we saw that the company that provided us with our bond ratings was Fitch, the Fitch ratings. There are also two other companies that evaluate bonds, Standard & Poor's and Moody's, but we referred to the Fitch ratings. And in this class, when we evaluate mutual funds, we're going to do all the evaluation in Morningstar, which is outside of the company, the Vanguard, for example. They evaluate all the different mutual fund families, and I want to use this as our tool. So up here in the quote box, I'm going to type in that fund, VDIGX, Vanguard Dividend Growth. Now, let's say I didn't remember and I'm looking up a fund. I could start typing in Vanguard Div, and there's the fund again. So I can do it by the name of the fund. So let's type that in here. So over here on my worksheet, I'm going to type in Vanguard Dividend Growth. The fund family is Vanguard. This is the owner of the fund. We deal with a lot of fund families. Fidelity would be another, T. Rowe Price, Janus, Wells Fargo has a family of funds. It's just the overarching name, and as we saw in over here in Vanguard, we see they have a lot of different funds. So that would be the family name. The specific name of the fund was Div Growth, and then the symbol down here was BDIGX. Okay, so how do we go about evaluating mutual funds? Well, we'd like to know what's in it. We always need to know what we're going to buy. So here in Morningstar, you're going to select portfolio. First of all, we're going to be using all the tabs on this line right here. Not all of them, but this is where we're going to go for our information. So within portfolio right here, first I'm going to note that this contains 87% US stock. It also has 10% of non-US stock, so it has a bit of international exposure. Next, over here, well, what type of companies are in this fund? And they are large and giant companies, so they're going to be in our large cap category, most of them, which means we'll recognize most of the names. I'm going to scroll down and note here where it says sectors. Okay, sectors. Well, what type of companies are in this fund? And I'm going to note that the top sectors, I guess, are industrials. So I'm going to list the top 5 sectors as industrials. And then I see healthcare. What's next? It looks like consumer defense. Defensive. These are stocks that typically do well in down markets as well as up markets. And then I have some financial. And lastly, I have consumer cyclicals. And we know what cyclicals are as well. Okay, so those are my top 5 industries. So this fund is not heavily invested in energy, which could be a good thing right now, or a missed opportunity, right? Because sometimes we like to buy into companies that are down, because if we have a long time, then we can purchase them while they're on sale and ride the prices back up, which would be a great thing. It doesn't have any utilities. It has very little technology, no communication, nothing like that. Again, under the defensive category, we're pretty heavy because we have healthcare too, which if you think about it, even in recessionary periods, healthcare companies still can do pretty well because we continue to need and buy healthcare products and services. Okay, I'm going to scroll back up here and I want to look at this next tab called Holdings. Holdings would be the specific companies that are in this fund. And I could put the cursor over all of these different bubbles right here, but instead I'm going to go to the list. This is in list by percent. So we note that UPS is represents 3.2% of this portfolio, followed by Microsoft, United Health Group, TJX, and Honeywell. So we have healthcare, we do have tech with Microsoft. UPS would be delivery service, and so on. I mean, you're going to recognize a lot of these names. So I'm going to come over here and I'm going to look at this, and it's UPS and it's Microsoft and United Healthcare or United Health, and so maybe here's why I want you to look at these. And you may not be that excited about some of these companies, in which case that's fine, because you can always, there's so many different mutual funds out there. You can always find one that maybe better suits what type of companies you like. So if this is not your favorite list, then let's find another. Okay, the next question over here is the turnover rate. The turnover rate. That really talks to how often the assets in this fund are sold, bought and sold. So a very high turnover rate, like a turnover rate of 100%, would mean that all of the companies within the portfolio have been sold in a years time, for example, and maybe new companies, or maybe they've been sold and rebought again. So there's a lot of buying and selling within the fund. A lower turnover rate would mean not too much buying and selling. And in this particular fund, the turnover rate is 23%. So about 23% of the assets are sold and maybe rebought, or sold and new and replaced with something else. And how would you evaluate this? Well, standing alone, it's difficult to evaluate this, but when we do our homework assignment, we're going to be looking at several different funds within the same category. And I'll show you how to look up category in a minute. And then we can say, wow, this particular fund has a turnover rate of over 100%, which means there's a lot of activity, a lot of buying and selling, which costs more money. And another one only has 20%, which is significantly lower. So it's another way to evaluate the risk of the fund. If there's a lot of activity, the fund typically is higher risk. Okay. Next big issue related to funds are fees. The video, we don't want to pay fees. In fact, this really upsets us when we have to pay excessive amounts of fees. The way we look at fees is to tap right here into expense. Next, go to this area right here, maximum sales fees. Note that there are no initial, deferred, or redemption fees for this fund. So 0 sales fees. However, every fund out there, including exchange traded funds, has a fee called an expense ratio. And it would be listed right here at the top. These fees here roll up into part of this fee. So we're not going to count these separately. Instead, we're going to note and understand that this top fee, 0.32%, represents the expense ratio for this fund. So down here, we're going to say no sales fees. Another word for sales fees is called a load. So in this case, no sales fees means no load. Okay, we have a no load fund. So let me clarify that and put no load. That's what we're buying. That's what we want, no load. But it has an expense ratio equal to 0.32%. And that would be the cost for Vanguard to manage this fund. That's the expense ratio, 0.3%. It's charged to the fund every year, and you or me or whoever owns this fund would pay this to be a player, to invest in this fund. Okay. Next question is the Morningstar rating. Well, we can see the Morningstar rating here is 4 stars. And Vanguard rates all mutual funds on a scale from 1 to 5 stars. In some cases, you'll find a fund that doesn't have a Morningstar rating, and typically that's because the fund is new. So it has not been around long enough for Vanguard to rate it. Now, what do these ratings mean? Well, I think these ratings are very important, because what Morningstar does is they say, okay, given a whole bunch of funds that typically have the same amount of risk, so let's say they, for example purposes, they all have a risk of 3. The fund that performs the highest or has a highest rate of return at this given level of risk is typically going to have more stars. So it's a risk adjusted return, and Vanguard likes to give higher stars to funds that outperform other funds given this fixed level of risk. So 4 stars is pretty good. Of course, we'd like all 5-star funds, but I think 4 stars is good as well. When we start getting into 3 stars and 2 stars, I think we'll understand why, and that's typically because they haven't performed as well and they may have significantly more risk. Next question says, well, if I invested in this fund, am I making any money? Because I want to make money. That's the whole key to doing this. So I'm going to tap here on performance. First of all, I'm going to look at the chart. So performance over time has been pretty good. It's gone up. What I really like to look at is down here, right here. These are total returns over a certain time period. So if I look at these returns, I would note, and when we evaluate mutual funds, we're not really looking at the 1 day, 1 week, 1 month, etc. What we want is history. How has this fund performed over time? These are, if I look over here, these are total returns. These would be daily returns, monthly returns, quarterly returns, but I really want over the last 10-year period, how has this fund returned on average? And its average annual return is about 9.7%. And is that return acceptable to me? Because I'm looking at the S&P 500. Okay, I could have just bought the fund called the S&P 500, and believe me, all of these companies have a 500 fund. It's just a big old index fund that tracks the S&P 500. So if I look at this fund, has it outperformed the S&P 500? Well, in the 10-year period it has. In the 5-year period it has not. And in the 3-year period it has not. 1 year it has. So, I mean, really, I could have just bought the index. I could have bought a fund that just represented the index over time and performed almost as well as this fund. So you should ask yourself, well, why wouldn't I just buy the index? And that's a really good question, because maybe you should. Maybe you should just buy the index. Typically, buying an index fund is cheaper than buying a fund like this one, because an index fund in general is called a passively managed fund, which means you do not have a whole army of individuals who are buying and selling in a fund to try to make money. Instead, you're just tracking an index. And really, it could be automated or completely done by a computer, and that doesn't cost nearly as much money. So we are always looking at comparing this to the S&P 500. And in this case, this fund has not significantly outperformed the S&P 500. But I'm going to go ahead and I'm going to put in here the 10-year return. So I'm going to do a 10-year as 9.7%, and then a 5-year as 14.10%, and then a 3-year as 15.2. Okay? Still good returns, still very good returns. But again, did not outperform the S&P 500. And right now, here, is this fund actively or passively managed? Well, if it is passively managed, let me go put a note in here, then it is an index. It would have the word index in the title of the fund. Actively managed funds do not. This fund is Vanguard Dividend Growth. It didn't say it was an index fund. Instead, it is actively managed. So we would write here active. So, which generally implies again that it's a bit more expensive. Okay, that's our returns, which by the way look pretty darn good over time. So if this was part of our retirement account and we were quite young, I think we would generally be happy with the returns of this fund. The next thing I'm going to look over here is well, for this level of performance, what is the risk rating? How risky is this fund? Lots of indications to measure risk, but we're going to stick with what we know, which is right here in the beta category. Again, R squared is how well it fits with the index. But if I have 3 years over here, I notice that my beta is 0.93, and it's in the category of the S&P 500 because it has a lot of large companies, which we know has a beta of 1. So it's about as risky as the market, about as risky as the market. So come over here and we'll put the beta rate as 0.93, and we'll note that it is about as risky as the market. Okay. Maybe later I'll get into R squared and alpha, but not on this video. This is to get you started on evaluating mutual funds. Okay, the next question is, who is the portfolio manager and what is his or her track record? So up here we would go to management, and the reason I like to look at this is not really interested in a brand new mutual fund manager. I'd prefer to have someone who has been around for a bit of time, and I'm going to notice that this person at the top has been there since 2006, so that's almost 10 years. So he has a track record, and again there's some previous managers, and you can read about their history. So again, we're just looking for some stability. If a mutual fund manager typically doesn't do so well, then they'll be let go. So this person has been around for a while, and so I'm going to say significant tenure, about 10 years. So this is a good fund. I think it's a good fund. It's one of the funds that I use in some of my clients' portfolios, and I wanted to show you some of the factors I use to evaluate it. I want to stop and tell you that there will be a time in your life where you will need to select mutual funds. That is because from the movie and from what you learn, mutual funds are typically in your company-sponsored retirement accounts. So when you go to work for a company and they have a 401k or a version of the 401k like a 403b or a 457, that retirement package will include a list of mutual funds for you to then select which ones are appropriate for you. So 401ks do not contain individual stocks for you to invest in. It's a list of funds. And therefore you will need to decide, well, how do I pick these different funds? How do I know what to pick? And you're going to remember this and go back to, okay, well, I know that I can evaluate mutual funds in Morningstar by looking at some of these factors here. And more importantly than that, you're going to decide what category of mutual fund do you even want to invest in. So if I go back here and I go to the quote page, the category of this fund right here is called large blend. Large blend. Large blend being a mix of very large and giant companies that are both growth oriented and potentially income oriented. So again, if I go back to my portfolio here, over here we have, this is sort of difficult to see, but let me just tell you. Okay, we're up in the large category, and over here these are growth funds. You know what a growth fund is because we talked about growth stocks, really buying them for growth in the price or capital gain. On this side, we have value funds. Now, value funds or companies are what managers consider to be undervalued, which means that the price doesn't represent how well the company is doing. So there's room for the price to grow. And then in the middle is blend, which would be a combination of value companies and growth companies. So that's what blend means. But really, the line is dim here because there's significant overlap. I want you to think about it in terms of large companies. Okay, these are very large companies for purposes of our investment strategies. Blend, again, just being a combination of value and growth. But this is the category that we're looking at. Now, we could also, if I go back to this quote page, maybe you are more risky, you're willing to take more risk. So you would want to pick not only large blend, but maybe you want to pick some companies that are in the small cap category or the mid cap category because they have more potential for growth. Uh, Again, when you are looking at your 401k list of funds, you could have 50 different funds on that list, and you're not isolated or you're not required to just pick one. You can pick several different funds and divide up your contribution to your retirement account across many different funds. Again, all related to your risk profile. If you were risk averse, you might say, you know what, I will never buy small cap funds, and instead I'm in my stock component, I'm going to stick to the large companies, and then I'm going to put more of my money in bonds. And again, alternately, you could probably find a target retirement fund on your retirement list and say, you know what, I'm just going to pick this target retirement fund, and I know that my assets are going to shift over time, and I'm just going to stick with one fund because that's how I feel comfortable. But you still need to, even among the target retirement categories, we still need to understand, really, is the fund performing? Am I making money on this fund compared to just buying the broad index? And then nextly, how much is it costing me? Because again, these fees matter. And you know that these fund managers can charge a fortune. And let me just pop into an example right here. So if I go back into my quote box and I type in this very popular fund called Growth Fund of America, right here by American Funds. This is a fund you may see in your 401k lineup. Okay, again, it's a large company fund. Its expense ratio is 0.66%, so that was higher than this Vanguard fund over here. But look at right here. Look at this. Load. Okay? Well, I'm going to pop into expenses because I don't like the word load. When I'm over here in expenses, here it goes, right here. I have an initial sales fee of 5.75%. And what this means is when I give this fund money, this is what they take off the top, 5.75%. So for every $100, I'm paying them $5.75. That's going into their pocket. That money is not invested on my behalf. And therefore, we are very cautious about these types of funds because it's just too expensive. This is a 3-star rated fund. And if I look at its performance, again, remember, every time I make a contribution to this fund, they're charging me 5.75%. So for that level of expense, if I'm going to pay them, I better see a performance that is completely outrageous, which I do not. Okay, this fund did beat the S&P 500 on a 10-year period. It did not, and about the same. But again, it's costing me significant amount of money, so it wouldn't be worth it. Wouldn't be worth it. So I really want you to pay attention to performance, and I'm going to pop in here to risk. This is going to be mostly large companies, so it probably has a risk that's comparable to the market, and it does, but it's expensive. So all things being equal, I would go for maybe this fund, same type of fund, but not nearly as expensive and performs similarly. Okay, well, that's almost 40 minutes worth of talking about mutual funds. Again, we spent a lot of time on this topic as well as exchange traded funds. So what I'm going to ask you to do now is, if you have a retirement account, I want you to go in there and take a look at your fund selection. I want you to pick the funds that you have selected and evaluate them, at least one of them, but preferably all of them, using Morningstar. I want you to fill out this form and then drop it in the Dropbox for your today's assignment. If you don't have a retirement account, then I just want you to evaluate a fund that I'm going to provide to you. It's actually a Fidelity fund. So you're going to go into the quote box and you're going to type in Fidelity Contra Fund. And I don't want you to have the K fund, I just want you to have the regular Fidelity Contra Fund. This is a 5-star fund, so I want you to evaluate it. The symbol is FCNTX. Take this fund, fill out the form with all the appropriate information, and drop it in the Dropbox. Again, you're on your way. These types of assets, mutual funds and ETFs, represent the primary method which you will use to invest your money. So it's important that you understand them and you know how to research these different funds. Don't ever forget that our goal is financial peace of mind when we retire and in our lives right now, and this is a major step to achieving that goal. So if you have any questions, of course, email me and let me know. I look forward to seeing your evaluations and have an awesome day. Thanks. Bye.